Over the past decade, the landscape of real estate transactions has undergone a profound transformation, driven by advancements in blockchain technology and digital assets. What once seemed like a futuristic concept, using cryptocurrency to purchase properties, has steadily moved toward becoming a viable, increasingly common practice. As we stand in 2025, this evolution prompts a critical question. Is buying property with crypto now truly mainstream, or is it still an emerging phenomenon on the cusp of widespread adoption? To understand this shift, it's essential to explore the technological innovations that have underpinned it. Blockchain, the foundational technology, offers a decentralized, transparent, and secure ledger system that has revolutionized how ownership rights, transaction histories, and contractual agreements are recorded and verified. Unlike traditional paper-based titles and bank transfers, blockchain provides an immutable record accessible to all authorized parties, reducing the risks of fraud and errors that have historically plagued real estate dealings. The initial experiments with cryptocurrencies in real estate primarily involved niche investors and pioneering developers. Transactions conducted in Bitcoin, Ethereum, or other digital assets often faced skepticism due to regulatory ambiguities, volatility, and the lack of standardized procedures. However, over time, these hurdles have been addressed through technological innovation and evolving industry standards. Today, a growing number of property developers, brokers, and institutional investors embrace blockchain-enabled solutions, signaling a shift toward broader acceptance. One of the most significant technological advancements facilitating this transition is the smart contract. These self-executing agreements, coded onto blockchain platforms, automate the enforcement of contractual terms. Once predetermined conditions such as verification of funds, property title clearance, or inspection approval are met, the smart contract executes automatically, transferring ownership rights or funds accordingly. This automation not only accelerates transactions, but also enhances security, transparency, and trust among parties. For example, a recent high-value commercial property deal was completed within a day, with a smart contract verifying all conditions and executing the transfer seamlessly. Complementing blockchain and smart contracts is the rise of tokenization, the process of converting ownership rights of a property into digital tokens stored on a blockchain. This innovation has profound implications. Instead of purchasing an entire property, investors can buy fractional shares represented by tokens. This fractional ownership democratizes access to real estate investments, allowing individuals with minimal capital to participate in high-value markets. It also introduces liquidity previously absent in traditional property investments, as tokens can be traded on secondary markets just like stocks. For instance, a luxury apartment complex in a major city issued tokens representing 10% ownership, raising capital from international investors and enabling liquidity through subsequent token trades. The convergence of these technologies has led to a more fluid, accessible, and efficient real estate market. Major cities worldwide now see a proliferation of properties listed for sale in cryptocurrencies or via tokenized platforms. Transactions are increasingly conducted through integrated digital platforms that simplify the process, combining user-friendly interfaces with secure blockchain infrastructure. Despite these advances, the industry still faces challenges. Legal and regulatory frameworks are evolving, and in many regions, questions remain about the legal recognition of blockchain-based ownership records. Ensuring that digital titles are recognized and enforceable is critical for widespread adoption. Additionally, the inherent volatility of cryptocurrencies poses risks for both buyers and sellers, complicating pricing and escrow arrangements. Many platforms have mitigated this by using stablecoins, cryptocurrencies pegged to fiat currencies, to provide price stability and reduce exposure to market fluctuations. Another obstacle is technological literacy. While blockchain and digital assets are familiar to younger, tech-savvy investors, many traditional market participants are still cautious or unfamiliar with these tools. This knowledge gap can slow adoption, especially among older or more conservative stakeholders. To address this, industry players are investing in education and developing more intuitive, user-friendly platforms that abstract technical complexities, making processes accessible to a broader audience. Furthermore, security remains a concern. Although blockchain is inherently secure, vulnerabilities in third-party platforms, smart contracts, or wallet management can expose users to risks. Ensuring robust cybersecurity measures and clear legal protections is vital for maintaining confidence. Looking ahead, several factors suggest that the integration of cryptocurrency into real estate transactions will continue strengthening. Institutional interest is growing. Major investment firms and real estate developers are actively exploring blockchain solutions to streamline operations, reduce costs, and expand their investor base. The proliferation of compliant, regulated platforms fosters trust and facilitates legal enforceability. Additionally, the increasing prevalence of digital natives investors, especially millennials and Generation Z, accelerates demand for innovative investment avenues. Moreover, the legal landscape in many jurisdictions is gradually adapting to this digital shift. Clearer frameworks for recognizing blockchain records, digital signatures, and tokenized assets are emerging, providing the legal certainty needed for mainstream acceptance. This regulatory progress encourages more players to participate confidently in crypto-based property deals. In terms of market impact, the trend toward tokenization and blockchain transactions is expected to increase liquidity, reduce transaction times, and lower costs, factors that collectively make real estate investment more appealing and accessible. For developers, offering properties for sale in cryptocurrencies or via tokenized platforms opens new revenue streams and broadens their customer base. However, some hurdles will persist. Price volatility of cryptocurrencies, despite the use of stablecoins, can still influence transaction dynamics. The complexity of smart contracts and blockchain technology may deter some participants until further simplification and standardization occur. Additionally, the global regulatory environment remains fragmented, and future changes could impact the pace and scope of adoption. In summary, the technological ecosystem facilitating crypto real estate transactions has matured significantly. The combined effects of blockchain, smart contracts, and tokenization have created a more efficient, transparent, and accessible market environment. While challenges remain, particularly regarding legal recognition, price stability, and technological literacy, the overall trajectory indicates that digital asset-based property transactions are moving toward mainstream acceptance. In conclusion, the rapid evolution of blockchain technology and digital assets suggests that the use of cryptocurrency in real estate is no longer a niche innovation, but a fundamental component of modern property markets. Now, as regulatory frameworks become clearer, technological platforms more user-friendly, and societal acceptance increases, it is reasonable to expect that by 2030, buying, selling, and investing in real estate with cryptocurrencies will be as commonplace as traditional methods are today. This paradigm shift promises a more efficient, inclusive, and transparent future for property ownership worldwide.